Hi everyone, welcome back to the channel. Today's video is going to be about market timing and whether it's something we should do, whether it's something we should be trying to do, get in at the right time, get out at the right time. I know I'm speaking from experience as I've in some ways been tempted to or tried to do this in the past. It's almost always been a mistake or a fluke. Um, but should we be doing it? What is market timing? And there's that you've probably heard this saying before. And time in the market is better than timing the market. So time in the market is better than timing the market. And I wanted to create a video which digs deeper around that subject. What should we be doing? Because it's very hard to know sometimes, especially when you want to eke out. You think you could be clever and you think you can eke out some extra rate of return by, what if I sell this and get in low on this stock and then sell out again before the other one runs up something. So I was a few weeks back, I was rereading a book that I've read by William Green called Richer, Wiser, Happier. This is a great book, by the way. It basically, there's a chapter for loads of different great investors about how they became richer, wiser, and happier. I guess it's a really good book to read. And there's a chapter on there about Howard Marks. Howard Marks is a very successful American investor. I think his compound annual rate of return is north of 18% or something like that. He runs Oak Tree Capital Management, $40 billion, no, 106, north of $150 billion assets under management. And anyway, there's Howard Marks is also famous for writing memos. So, and they go back years, decades even. So he writes memos to his investors, and it's kind of a piece of writing around a thought that he has at the time or his thinking at the time. And in the book Richer, Wiser, Happier, in a chapter about Howard Marks, it talks about this concept of timing the market, and it references his 1993 memo. And I'll just show you it here. I'll link it down in the description below. I've got it open here actually. So he talks about, so just here in this paragraph here, a bit further down the memo, the average annual return on equities, and this is a large time period, from 1926 to 1987, which is a 61-year time period. So the average rate of return was 9.4%. But if you'd gone to cash and missed the best 50 of those 744 months, you would have missed all of that return. So this tells Howard that attempts at market timing are a source of risk and not protection. So what he's getting at there is, if you try and time the market and get in and get out, you may be getting out at the wrong time when you should be remaining in the market. And if you had missed only 50 of those 704 months, which is about 7% of those months, then you would have had no return over a 61-year period. You wouldn't have had the index 9.4%. You would have had absolutely no return. So just think about that. You miss 7% of the months, and you've earned nothing over 61 years. And it's always hard to know when to get back in as well. You get out the market if the market starts running up. It's hard to know when to get back in. A lot of people don't get back in, or they get back in and they've missed, one of the best months in the market. Another example I'd like to talk about as well. It's a more recent study that William Green also talks about in the book. He references an article by Calamos Investments. So they are a large, diversified global investing firm with about $40 billion assets under management. And I'll link this down in the description as well below. But they put out an analysis of various different things, and they talk about timing the market and how you can get whiplashed. And so this is over a 20-year period. So it's 1999 to 2019. And in that 20-year period, think how many days are in a 20-year period. So in that 20-year period, if you missed the best 20 of those days, just 20, your $10,000 starting amount would have basically gone nowhere. You'd have earned $167 extra. So if you'd have remained fully invested, you'd have had a triple in your value, more than a triple, to 32,000. But just missing 20 of the best days in that time period. I mean, that's 0.3% of those days in those 20 years. If you miss 0.3% of those days and they happen to be the 20 best days, that's it. You've got no return over that time. So it really kind of highlights that it doesn't take much to miss out on some great returns. And you should really just stay in the market, and timing the market it's always so hard. I mean, a lot of the time, well, most of the time, the market in the short term trades on speculation, and the price movements and the fluctuations are not always based on the fundamentals. In the long term, like Benjamin Graham says, the market is a weighing machine in the long term, but in the short term, it's a voting machine. And you don't know when those massive gains are going to come, and you might be out of the market because you think you're clever. You might be out of the market at the wrong time. I did want to highlight one more thing from Guy Spier's recent annual report. So he started putting those out. I think the 2021 was the first time he started putting those out. And he talks about, amongst other things, he talks about inflation, the environment we're in right now, how inflation can affect us in our, it's quite a recent writing. It's his 2021 annual letter. But he proposes in here, he says, imagine that you own some excellent downtown properties in major cities like London, Paris, Berlin, New York, Chicago, and San Francisco, unlevered, so you don't have the debt or mortgages against them. So Class A office blocks, hotels and residences, prime locations. Imagine now a terrible scenario in which a world war is coming and 3 of these cities will be carpet bombed. So what should you do? Should you sell the world's best real estate and go to cash and keep the proceeds hidden away in a vault? Should you sell some of the prime real estate and buy non-prime properties on the edge of the cities, hoping that they won't be affected, or maybe in less desirable cities, but they might get bombed anyway? Or should you stick around with the best assets and take the hits, and if and when they come, safe and secure in the knowledge that you'll still own some of the world's best real estate on the other side of the extreme turmoil you're going through? And it's kind of a thought process and an analogy. What should you do? You don't know which cities are going to be affected. Is it not better to just know that you have some of the best assets that you've researched really well, and ride it out? I think it's also important to remember that understand your own limitations, and remember that any time that you spend thinking about timing the market or getting in and getting back out at the right moments, any time you spend doing that is time that you're not spending researching companies, or time you're not spending advancing your value investing knowledge, and advancing that goal to financial freedom. Because I truly believe that time spent thinking about short-term price movements, even if you think you're sure that the market's about to crash, and you've got a company, let's say, that isn't quite at full value, or ordinarily, if you didn't think a crash was coming, you wouldn't sell it, but you think, I'll sell it because I think a crash is coming. And even if you're really sure that is going to happen, you don't know. There's many things that you don't know, and markets can do very irrational things. One of the worst pandemics for centuries or decades, and the market dives and then turns around and goes straight back up. I mean, a lot of that caught a lot of investors. That blindsided a lot of investors, and because they thought it was a dead cat bounce, or sorry, I thought it was a dead cat bounce. To be honest, I made some wrong market timing decisions in the March 2020 as well, and I have done these things before, and I can speak from experience that just don't do it. Don't try and time the market. Just it's wasted brain power, wasted time. Think about the company you own. Think about buying more as it goes lower, because you don't know what the future holds in the short term. Or you can just focus on buying great businesses at conservatively great prices, where your chances of a high rate of return are very high. Value a business and buy it much less than it's conservatively worth is a quote I always remember from Warren Buffett. And some of the best investors in the world, Warren Buffett, Charlie Munger, and Monish Pabrai, I've heard them talk about many times that they don't even look into any macro stuff. They don't, that doesn't factor into their thesis for buying a company, whether what inflation is going to do, or interest rates are going to do, or whether Russia's going to invade Ukraine, or whether there's going to be another pandemic or another world war. The market has gone up decade after decade after decade, over a long period of time. And I'll just put up a chart on the screen here of all these things that have happened across this large time frame. And they could have all been reasons to time the market and sell, but you can see that you would have been wrong to do that. And none of these great investors, these great value investors that have high concentration portfolios, they look at from a bottom up point of view. They look at is this company going to be bigger and larger in 10 years, and by how much? And can I buy it conservatively and make a good rate of return? They don't worry about what the macro is going to do. And I certainly suggest that you do the same. I know it can be hard, because certainly when you don't want to see your on paper value disappear. And I've had many times where things have gone down, and I'll be like, damn, I knew it. I knew I should have sold. I knew I should have sold. Such an idiot. But you can't know that. You can't know that. I'm actually in a position right now where, I've got a company that's gone down quite a lot since I bought it. And naturally, I think, what if I'd have sold? Even if I'd have sold half, I could have bought in, more lower down. But it could have equally gone the other way, and I'd have this cash, which I'd have to deploy at much less favorable rates of return. So timing the market, don't do it. If you do it, you'll just learn the lesson the hard way. Try and learn the lesson the easy way. Listen to me talking about listening to all these great value investors that talk about not timing the market. And hopefully some of the examples I've given you illustrate as to why you really shouldn't. Because if you miss some of the best months or days over quite a long time period, it can just wipe out your rate of return. So I hope you got some value out of today's video. Send me some comments below. I'd happily, happily interact with you in the comment section if you've got any questions or ideas of future videos. And otherwise, I'll let you get back to your day. Let's all go out there and become super investors together. I'll catch you on the next one. Take care.